all the indicators you want to look at were very weak other than for central banks. So it was central banks who were buying gold, and they were not buying gold as an investment because of the investment scenario, because the investment environment of interest rates going up and a strong dollar is of course negative for gold. They were buying as an insurance. And when you're buying partly, mostly as protection against the dollar, weaponization of the dollar. So when you're buying with that objective in mind, you're price agnostic, you just want to buy. That sort of set in the scene. And that explains, to me, why gold was going up so much, but the gold stocks weren't, which was the big question that everyone was asking last year.
AdrianDay is a highly regarded international advisor and the esteemed editor of Global Analyst, known for his expertise in global investment strategies. In his analysis, Adrian emphasizes the central bank's significant role in purchasing gold, highlighting that despite the rise in gold prices and potential shifts in monetary policy, there is a persistent lack of enthusiasm for gold investment among Western investors, as evidenced by ongoing ETF outflows. These outflows have continued into March, marking the 10th consecutive month of declines, albeit at a slower rate. Goldman Sachs recently increased its year-end gold price forecast from $2,300 to $2,700 per ounce, noting that the usual macroeconomic factors are not driving the current bull market in metals. Instead, potential federal rate cuts could mitigate the negative impact on ETFs later in the year, coinciding with uncertainties from the U.S. election cycle and fiscal settings, thereby maintaining a bullish outlook for gold. From a technical perspective, Adrian has observed an uptick in gold purchases by Chinese investors who are turning to gold as a stable investment alternative amid limited options and growing concerns about the Chinese economy. This year's unexpected surge in gold prices, despite significant market headwinds and a dip in prices this week, has puzzled market watchers. After much debate, it's becoming apparent that a major new force in the market may be a group of agile retail investors active on the Shanghai Futures Exchange. We now present clips from AdrianDay's recent interview on natural resource stocks. To continue this discussion and stay updated with our latest videos, please subscribe to our channel and activate the bell icon for timely notifications.
All the indicators you want to look at were very weak other than for central banks. So it was central banks who were buying gold, and they were not buying gold as an investment because of the investment scenario, because the investment environment of interest rates going up and a strong dollar is of course negative for gold. They were buying as an insurance. And when you're partly, mostly, as protection against the dollar, weaponization of the dollar. So when you're buying with that objective in mind, you're price agnostic, you just want to buy. Just as when you buy house insurance, you might shop around, but you don't say, I think I'll wait 6 months until the prices come down. I mean, you get the best deal you can at the time. So you're price agnostic. So anyway, that sort of set in the scene. And that explains, to me, why gold was going up so much, but the gold stocks weren't, which was the big question that everyone was asking last year. It makes sense because the central banks, the buyers of gold, wanted fiscal gold. They did not want Newmont. They certainly didn't want Ajax Exploration or Consolidated Moose Pasture. And so what we've seen this year is really interesting. What we've seen this year so far is only a very slight shift in that buying, frankly. We've had a new buyer that's Chinese buying. That came in this year, and particularly after the Chinese New Year. And when you think about it, Chinese they're both concerned about the economy in China, and they also see potential for some monetary easing in China. But they're concerned about the economy, and they don't want to leave their money in the banks because the banks are unstable. And Chinese buyers, traditionally, if you look at the avenues where Chinese buyers go, they do like stocks. But stocks in China are way down. May be a good opportunity, but you and I both know that most people buy things when they're going up, not when they're going down. Real estate. The Chinese love real estate. but they're not going to be putting their hard-earned savings into real estate right now when they're concerned about the economy. So what do they buy? Bitcoin? Oh no, that's illegal, I forgot. So the only thing left is gold. So you can see Chinese buying of gold, both speculative buying from the Shanghai Exchange and also physical buying, has been very strong in the last 6 weeks. But you look at the other indicators that I mentioned, coin sales, ETFs, we've seen what I would describe as a modest shift, and I'm talking Western now, Western ETFs and Western coin buyers, US or North America and Europe. We've seen a shift, but by no means a sharp shift or a change in direction. So you look at ETFs, for example, January and February, every single week was net outflows from ETFs. Even though gold was going up the way it was, even though Powell was talking about cutting rates, astonishingly, still net outflows.
Despite the allure of potential investment returns, AdrianDay suggests that investors who are wary of the financial system prioritize owning physical gold for security rather than opting for ETFs or futures contracts. Additionally, Day highlights the strong earnings potential and undervaluation of gold mining companies, citing Agnico Eagle's price-to-free cash flow ratio as evidence. While caution is recommended for those heavily invested, Day advises that those underinvested or without exposure to gold stocks might find it an opportune time to buy. Gold prices have increased by 14% this year, which should ideally boost gold miners, though this hasn't yet materialized. However, with less inflationary pressure expected in the future, there could be a push that enhances the value of miners, creating more trading opportunities. Furthermore, major players in the gold mining industry, such as Newmont and Barrick, are beginning to show signs of strength at the start of a relatively slow second quarter for the broader stock market. Now, let's return to the interview.
I think we're seeing more and more people wanting to take delivery of their gold, not wanting to trust, intermediaries and paper gold. And maybe that's one of the reasons that the ETFs haven't been seeing the buying. I mean, I'm not one of those who thinks that I'm not one of those who thinks they don't have the gold. Maybe I'm naive, but they have audits by 2 different firms every year, and so. But anyway, if you're buying gold because you think it's cheap and because interest rates are coming down, and you think over the next year you can make 20% on your money, and you don't really care, why go out and buy physical and have to store it? Why not just buy an ETF or buy a contract on the COMEX? But if you're buying gold because you're actually afraid of the financial system, well, you want physical. The plain fact is that today they are pretty low, and the earnings, this first quarter's earnings and the second quarter earnings, should be pretty robust. When you've got gold at 2,200 or 2,300 as it is, today, even after the decline, it's over 2,300, and you've got all-in sustaining costs of 1,400 and 1,300, those are robust margins.
Yeah.
So, and we tend to forget that. Now, I think the market is right to look at costs, because that was what killed us in 2011. As costs ran out and people were only looking at the price of gold, not at the cost. So anyway, I think that they're very undervalued today. And I get the example of Agnico's price-free cash flow, but I could give other examples of NAV and earnings and, so on and so forth for other companies. So the stocks are cheap, and they're still nowhere near at their high prices. The industry is robust, and they are very, as I mentioned earlier, they are very, very undervalued. When the sector turns, let's not forget, we've all seen those comparisons of gold stocks versus Apple or versus Tesla, and they're definitely worth looking at. But I'll give you another one, if I may. The value of every gold stock in the world, including the exploration companies, is maybe $400 billion. You look at the largest gold mining company, which is Newmont, which is about, $50 billion?
Yeah.
Well, NVIDIA has had 10-minute moves that are 4 and 5 times the market cap of the largest gold mining company in the world. Tesla has traded more in a single day than the market cap of the largest gold mining company in the world. The point I'm making is, when money turns into this sector, the stocks are going to move dramatically. Now, would I be buying now? That's always a difficult question, because when you're already pretty fully invested, I would say there is no need to increase right now at this point. If I was underinvested or didn't own anything, I would certainly want to buy.
China's central bank is leading a global surge in gold reserves, setting new records for central bank gold purchases worldwide. However, recent spikes in gold prices can be attributed to heightened activity from retail investors in China. How do you see the future of gold prices and mining stocks evolving given these market dynamics? Share your thoughts in the comments section below. If you found this video informative, please support our channel by subscribing and turning on notifications to stay updated with our latest content. See you in the next video.